Fed is the least important, not because the Fed isn't powerful or because we want to fight the Fed. It's just that you're looking at a 16% chance of a cut. That could go to zero the next time we get a hotter than expected print on something. It could also double to, a 32 or a 40% chance the next time we get something disappointing on the labor front. But the reality is this has just been an incredible year for asset owners around the world. It's so much bigger than just whatever the FOMC is going to do. And the reason why what I'm saying I think is important is because the momentum is probably not going to stop on a dime just because the calendar turns over from December 31st into January. I want you to consider the top 3 performing sectors this year. Communication services stocks are up 34%. Tech up 25, industrials up 20. Not far behind are financials. You just take those 4 sectors, that is a huge chunk of the market. There are, I think, 13 or 14 S&P 500 stocks that have gone up more than 100% this year. But then you look at other asset classes away from the S&P, and you realize that what's happening here is so much bigger. Europe is up 36% year to date. International emerging market stocks up 34%. International developed is up 32%. Brazil's up 50%. Canada up 37%. That's not the Fed. It's nothing to do with it. In fact, in Japan, they had 2 rate hikes this year, and the stock market broke like a 4-decade high. Gold is up 65%. The commodity index is up 20%. The ag is up 7%. Tips are up 7%. Even cash is up. The only thing I could find that's down is Bitcoin. So we're not talking in 2026.
I kind of doubt it. Frank, we were here yesterday, and I remember talking to you about signal versus noise, and I feel like the minutes are going to be a lot of noise because of all of that dissension, frankly, on both sides, and because the things that caused that dissension have not cleared up in the last few weeks, and they're not going to clear up probably for a couple of months yet. Those items being things like how much is the labor market weakening, and where is inflation and the effect on tariffs. I do think that the Fed is going to be wise to pause here. For how long we need to see, but certainly the next meeting, I don't think they should be going. Let's get another couple months worth of inflation data and jobs data. By the way, we talked about this yesterday too, but I continue to think this is very important. When the Supreme Court rules on the legality of the tariffs as they're currently enacted, that's going to put a lot of things into an uproar. That may change the inflation numbers if tariffs are at least temporarily ruled illegal. The president will, of course, use different statutes, but things are going to be up in the air. And I think with the amount of easing that the Fed has done over the last year and a half, they have the luxury now of waiting, and they should take that luxury.
All right, Jason Snipe, when we're waiting for these Fed minutes to come out, in the build-up to it, is there anything you're anticipating, anything you want to look at when it comes to these Fed minutes, or anything about the Fed that you think this could at least potentially clarify?
I don't think so, Frank. I echo a lot of Jim's sentiments, and Frank, you already said it at the top, right? 3 dissents. The Fed's never been more divided, well, at least in the last 6 years, let me say that. For me, I think the focus for the Fed clearly is labor. That is the concern for them. It'd be interesting to see if there's some commentary about inflation, right? I know that it's obviously been a dual mandate for years, but they have definitely veered off into the Labor Department. We know labor is soft, so I don't expect anything earth-shattering in terms of the minutes. But my focus is kind of going into 2026. I think directionally we're still heading lower. There will not be a cut in January, but I think that with the Fed share shift happening in May, looking into the back half of the year, I think that's the focus for me in terms of where policy goes.
All right, Josh, same question for you. Anything in these minutes that's potential to change your view of the market right now? The Fed in 2026, 2 cuts priced in as of right now.
The Fed is the least important chess piece on the board right now. Out of all of the things that are driving markets globally, not just in the U.S., literally the Fed is the least important. Not because the Fed isn't powerful or because we want to fight the Fed. It's just that you're looking at a 16% chance of a cut. That could go to zero the next time we get a hotter than expected print on something. It could also double to a 32 or a 40% chance the next time we get something disappointing on the labor front. But the reality is this has just been an incredible year for asset owners around the world. It's so much bigger than just whatever the FOMC is going to do. And the reason why what I'm saying I think is important is because the momentum is probably not going to stop on a dime just because the calendar turns over from December 31st into January. I want you to consider The top 3 performing sectors this year, communication services stocks are up 34%. Tech up 25, industrials up 20. Not far behind are financials. You just take those 4 sectors, that is a huge chunk of the market. There are, I think, 13 or 14 S&P 500 stocks that have gone up more than 100% this year. But then you look at other asset classes away from the S&P, and you realize that what's happening here is so much bigger. Europe is up 36% year to date. International emerging market stocks up 34%. International developed is up 32%. Brazil's up 50%. Canada up 37%. That's not the Fed. It's nothing to do with it. In fact, in Japan, they had 2 rate hikes this year, and the stock market broke like a 4-decade high. Gold is up 65%. The commodity index is up 20%. The ag is up 7%. Tips are up 7%. Even cash is up. The only thing I could find that's down is Bitcoin. So we're not talking about when's the next 25 basis point cut. What we're really talking about is a wealth creation atmosphere of enormous magnitude. A lot of people have been underweight. They haven't been involved in international, or they've forgotten how to buy things that aren't S&P 500. And I think that should really be investors' focus for this coming year. What do I own? Do I own enough of it? Is it meaningfully diversified? And does it have an opportunity to outperform in an environment where the S&P is selling at 22 times earnings?
All right, Josh, we're going to talk a lot more about that broadening coming up just a bit in the show, but you're saying the Fed is the least important piece on the chessboard. I'm going to go to the chess master in this case, our Steve Leisman, to talk about these minutes coming up. Steve, what are your expectations? We know about the dissension in the Fed. We know that the issues that they're trying to weigh, it's labor and it's inflation. What are we going to learn today?
I just want to use the term en passant just to really show my how much I know about chess, Frank. But look, Jim said, wait for the data. Josh said the Fed doesn't matter very much right now. And I kind of agree with both. Let me see if I can put it together, which is this notion of waiting for the data. I think that's one of the reasons why the probabilities for January are so low, why it's a 50-50 slot or probability for March, because we don't really have a clear picture. And if the outlook remains, Frank, the way we think it is, which is that inflation either is stagnant or starts to come down, the job market remains somewhat weak, then I think we understand the direction of travel. And that makes Josh right, which is that in that context of a Fed that's either sticking where it's at or possibly lowering rates over the next several months, then that's not something the market has to worry very much about. The danger becomes if we do wait for the data and we get a picture of the economy that's different from the one we thought. In other words, a surprise on inflation, a surprise on growth or employment, then I think Josh would be wrong and we would have to care about the Fed.
All right. Coming up next year, not only are we expecting to get the president announce his pick for the new Fed chair. Remember, Jay Powell, not remember you, I know you know, but Jay Powell's the chair up until May. But we also get 4 new voting members. The Cleveland president, Beth Hammack, you did a great interview with her just a few weeks ago. Neil Kashkari in Minneapolis, Lori Logan in Dallas, Anna Paulson in Philadelphia. Are any of these people, are they likely to change kind of the, I guess, the texture of the FOMC and come up with a different point of view than what we're expecting to see in these minutes?
I don't think so, Frank. And I think one of the reasons is getting back to what Jim said, wait for the data. Look, Hammack and Logan have been a little bit more hawkish. Kashkari maybe a little bit more like them, not quite as hawkish. Paulson a little bit more dovish. John Williams, I interviewed not too long ago. He sees rates coming down. Again, I'm going to come back to where Jim started. And the big unknown for next year is just what is this economy doing right now? You have this conflict between strong GDP growth and weak labor market growth, and that could be joined or solved by the issue of productivity. If that ends up being right and a big story for 2026, the Fed can cut into that process. And I don't think that people like Hammack and Logan are going to stand in the way of that if you don't have inflation as a problem. The real issue, the real divide is how big a deal is 3% inflation. Well, if it starts to come down, it's not a big deal. And if the job market remains weak, that clears the way, gives the Fed a green light for cutting rates. If it goes the other way, Frank, it can't be understated how difficult it is for the Fed right now. And by the way, economists on Wall Street as well. Now, the easy thing to do, which is what I think Josh is focused on, is the outlook for earnings. That remains positive. And if the economy
Hey guys, welcome back to my channel. I hope you all are doing well today. Let's start our video. We just received an important breaking update that could significantly impact NVIDIA and the entire AI trade. According to the fresh Reuters reports, NVIDIA has informed Chinese customer that it planned to restart the shipment of its high-end H200 AI processor to China as early as mid-February. This is a big development because these chips were previously considered off limit due to the US China trade restrictions, and Nvidia has been operating under the assumption that China revenue will be remain close to zero. The report suggests that the initial shipment could include somewhere between 5,000 and 10,000 H200 modules. Through nothing will move forward without the final approval from Chinese regulators. So while Nvidia is preparing behind the scene, Beijing still holds the final say. And this is where the political and economic layer begin to overlap. Advanced semiconductors have been a form of leverage in international negotiations. Rare earth materials, agricultural trade, and high performance chips are now all part of the same global chessboard. However, control the advanced compute, control the productivity, automation, defense, and the long term economic power. And that is exactly why this potential reopening matters. From an investor standpoint, Nvidia stock still trade below its long-term historical valuations multiple. Despite delivering the record revenue growth, bulls believe we are still in the early inning of a multi-year global AI infrastructure build-out. Skeptics worry about the power constraint, funding bottleneck, and the whether the spending might slow. But the truth is this: every major cloud provider is expanding capacity, and the NVIDIA remains the central hardware layers powering that expansion. New architectures like TPUs and the custom chips are not replacing NVIDIA. They are expanding the total computing ecosystem. This is not a fight over the slice of the same pie. The pie itself is growing rapidly. China was once NVIDIA's second largest market. If even partial shipment analysts will be likely to revise their revenue models and long-term price targets. This alone could add a 10 of billions of dollars of potential future demand. And even without China, NVIDIA data centers business continue to grow aggressively, which means China reopening is an upside, not an requirement for NVIDIA long-term success. Recent efficiency improvement reported at OpenAI also highlights NVIDIA value proposition. OpenAI has drastically improved how efficiently its run models, which means faster response time, lower operating cost, and the higher margins. And NVIDIA hardware continue to be the core of that compute stack. In the simple term, higher performance, higher profitability, more investment, more NVIDIA demand. That flywheel is already spinning. NVIDIA has also quietly reoriented its internal cloud infrastructure to focus more heavily on internal R&D, next generation AI model development. This isn't a sign of weakening demand. It is a sign of NVIDIA is preparing for the next wave of compute intensive workload. Now a quick update on Iron. Iron control land, power, cooling and compute, making it one of the most vertically integrated AI infrastructure builder in the market. They currently have over 1,200 workers on site, expanding facilities, and they have secured multiple gigawatts of renewable power. Iron is projecting annual AI cloud revenue in excess of $3.4 billion by 2026, which will be represent the exponential growth from the current levels. Importantly, this is a high margin cloud revenue, not a low margin crypto mining. Looking ahead, Jensen Huang will also delivering the two major keynote addressing at CES 2026. While CES is a primarily consumer focused and the guidance is related to the robotics and physical AI or a next generation computing platform could influence the sentiment in the short term. But regardless of near term catalysts, Nvidia long term structure remain extremely strong. One of the most undisrupted growth segment is physical AI, robot factories and the autonomous systems and the machine driven production. NVIDIA is building the foundational software and the hardware layers of the entire industry. Omniverse stimulation, CUDA training, and the AGX Edge interface. GPU superclusters of AI factories. Over 2 million developers are already building within the NVIDIA robotics ecosystem. This is not a speculation, that is the infrastructure being laid. Production ramp are already mapped well into the future. Blackwell Ultra is scaling rapidly today, Rubin launches in 2026. Rubin CPX follows shortly after the Rubin Ultra and Phenomenon extend the roadmap into the 2028. Jensen expects 3 to 4 trillion dollars in a global AI factory build out by 2030. That implies demand growth measured in years, not on quarters. We are not in a bubble, we are in a shortage economy. Short on power, short on memory, short on data centers, and short on compute, which means this is cycle is far from finished. With all that said, I continue to believe NVIDIA has a massive runaway ahead. Stay patient, stay long term focused, and avoid emotional trading this season. Let me know your thoughts in the comments and hit the like button if this helped you. And consider subscribing for more updates. Thanks for watching. I will see you in the next video.